This is part 4 of proactive risk-taking and value investing. In the first half of 2008, I had 66 trades. That is, I purchased and sold 66 different stocks. Now, if the idea is to have a long-term value, to purchase something because it's undervalued, and over the long term, it'll eventually sell at its true value, for the reasons that it's throwing off excess cash and all the things you can do with it. A value investor assumes that eventually it'll be recognized. So why would this call for 66 different purchases? Well, if you purchase a stock that's undervalued and it goes up 15% a year, every year, or 20%, that's a very good return. But if something goes up 50% in a month, then that's 3 years worth of gains. If you pass that up, there's a good chance that it'll keep going up if you sell it, but there's also a good chance that it'll go back down because it's not being pushed up by its true value. It's being pushed up by a lot of people jumping on momentum. And so I felt required to sell these things while I had a profit. In particular, I started out with $212,000. This is my niece's account. I trade on her account. She does not trade on it. And then at the end of the year, I give her she takes some money out. Last year was $50,000. And then this year so far, she's up about 43. Now, the stocks that I purchased and sold, were for the most part natural resource stocks. They were oil and gas producing companies. Chesapeake, Devon, Apache, Petrobras, and these things moved up dramatically, 30–40% in a month. And so the only thing I could do, being essentially somebody who's cautious, a value player, was to take these huge gains while I had them. There were a couple of other stocks that were in the area of engineering services. These are companies that build water projects, highways. They do the engineering, the planning, but they don't have huge amounts of capital outlays. They don't have to take all the cash they generate and put it back in the business just to stay even. And so there were 3 of those. There was one litigation consultant, a consulting company that has specialists in law and in other kinds of fields that companies hire when they're faced with lawsuits or when they're seeking a strategy, such as the mortgage crisis coming up. Another purchase was Swiss Reinsurance. This company was selling at a substantial discount to its liquidation value. It had a book value of the bonds and other assets that it held which they could then use as reserves backing the insurance policies they were selling. This is a reinsurer. They got a bounce when Berkshire Hathaway bought an interest in their company, and Wall Street reacted by buying it, not because it had more value, but because Berkshire is a big name on Wall Street. It's Buffett's company. And so when it popped, I sold it. It had like 20% gain. And that's a whole year's gain, and it came in about a month. Humana is a health insurer, an HMO. And when they announced disappointing earnings, the stock dropped about 35% in an hour. And so I went to the news. The account, my niece's account, is with Fidelity. I went to the Fidelity website, looked up the news, and they announced that they had mispriced the Medicare D insurance plan. What they had to pay out was more than they expected, and they could correct that. And so the company still was going to generate free cash flow of about $4 a share. And it was trading for about 34, so I bought it. And it went up in about a 2-week period. It went up about 35, 40%. So that's the time to sell it. If you get a 2 or 3 or 4 year gain in a matter of a week, then you sell it. There was one other company called Chimera. It was spun out by a mortgage insurer of relatively high quality. And they spun it out at a time when it looked like it was a good chance to capitalize on the credit crisis. New company with lots of cash. And it went from 15 to 18 and a half in about 3 weeks. So I sold it. Now it's 9. Was it a good buy? No, it was a stupid thing. I mean, the thing is selling for 9 now. It should have been selling for 9 when I bought it. But I got lucky on that. And I got lucky shorting oil when it was about $90 a barrel. It happened that it went down for a while, and I made $2,000. My basic conservatism told me to cover my short, and I did it. It was a stupid thing to do, to short it to begin with, because oil is up $50 since then. But I got out quick. The mistakes were basically on companies that were going to benefit from the world build-out of infrastructure. And apparently, this is something that's slowing, and I didn't see it. So, the world infrastructure build-out seems to be something that has a promise of high free cash flow for some American companies, but is petering out at the moment. When these drop enough, perhaps they'll be good buys. So, idea is that you need to be nimble and get out if you don't understand what's going on and you have a profit.